Welcome to TalkTickers. We're your shortcut for getting straight to the heart of earnings calls. Today, we're diving deep into the Texas Roadhouse first quarter call for 2025. We'll pull out the insights that really matter for experienced investors like you.
Absolutely. And Texas Roadhouse certainly delivered a strong start to the year. Revenue jumped 9.6%, over $1.44 billion.
Okay, 9.6%. That's pretty solid growth.
It is. And it was driven by a healthy 3.5% bump in same-store sales. That's across Texas Roadhouse itself, Bubba's 33, and Jaggers.
All three brands contributing.
Yeah. And what's interesting is the momentum actually built during the quarter. March apparently hit all-time high average weekly sales for all the brands.
Wow, okay. And did that carry over?
It did. They said the first 5 weeks of Q2 saw comparable sales up another 5%. So that positive trend is holding, for now at least.
Okay, top line sounds robust. But what about the bottom line? How did earnings look?
A bit more modest there. Diluted earnings per share saw a 1% increase, landing at $1.70.
That's 1%. So margins might be feeling some pressure.
That's what it looks like. Restaurant margin dollars were up 4.7%, which is good, reaching $239 million. But as a percentage of total sales, the margin actually dipped slightly to 16.6%.
Right. So more money coming in, but each dollar is bringing slightly less profit to the restaurant level.
Exactly. It suggests, while sales are great, costs are definitely a factor they're managing.
Okay, let's dig into that 3.5% comparable sales number. What actually made that up?
It was a mix. About 1.1% came from more people coming in, traffic growth, and the other 2.4% was from a higher average check.
People spending more per visit.
Correct. And it's worth pointing out their to-go business is still a really significant piece of the puzzle. It was 13.6% of total weekly sales.
Still holding strong post-pandemic then.
Seems like it. It really highlights how they've adapted to different ways people want to dine.
And that average check increase, how much of that was pricing versus people just buying more or different things?
Good question. Pricing actions added 3.1% in Q1. They're expecting that to moderate a bit, maybe around 2.3% for the rest of 2025.
Yeah.
And, it's important to remember Texas Roadhouse typically doesn't try to price fully for all the commodity inflation they see.
Right. They try to balance price with value, so they're relying on other things too.
Yeah, exactly. They have to be. They mentioned improved mix trends, especially early in Q2.
What does that mean, mixed trends?
It's about what people are ordering. So early Q2 saw more folks choosing entrees and appetizers, which generally have better margins. That helped offset a little bit of softness in alcohol sales.
Okay, so higher margin food items helping out.
But there's always a flip side. In Q1, there was actually a bit of a negative mix impact on their cost of goods sold.
How so?
Because more guests were trading up to higher cost steak entrees. Good for the check average, maybe, but tougher on the food cost line.
Makes sense. Delicate balance. What about inflation overall? What are they guiding for?
Well, they bumped up their forecast for commodity inflation for the full year, now expecting around 4%.
4%, and that includes tariffs.
Yeah, they figured tariffs will add about 30 basis points to that. Seafood is going to be the hardest hit category there.
Okay. And labor, still a pressure point.
Definitely. Guidance there is holding steady at 4% to 5% inflation for the full year. They mentioned focusing hard on productivity initiatives to try and manage those labor hours relative to traffic.
Right, trying to get more efficient to offset the higher wage rates.
Exactly.
So back to that slight dip in the restaurant margin percentage. How worried should we be, given those cost pressures?
Well, context is key. Restaurant margin dollars per store week did dip slightly in Q1, which isn't ideal. But they're lapping a really strong 2024.
True. Comparisons matter.
Right. And doing that while juggling today's inflation is tough. The fact that absolute margin dollars still grew shows that the strong sales are providing some cushion. Plus, they mentioned finding some leverage in other operating costs during Q1.
So finding savings elsewhere to help out.
Seems like it, yeah.
Let's shift gears to expansion. That's always a big part of their story. What's new?
They're moving ahead. Opened 8 company-owned spots in Q1. The plan is still for about 30 total this year.
30. And that includes Bubba's and Jaggers?
Yep, includes up to 7 Bubba's 33 locations and 1 Jaggers. They also bought 1 franchise location in Q1 and expect to acquire 3 more in Q2.
So a mix of building new ones and buying existing ones.
Yeah, seems like a balanced approach to growing their footprint.
And I saw something about tech investments.
Absolutely. They're pushing ahead with their digital kitchen tech. Said about 65% of restaurants have it now.
65%.
Yeah, and the rest should be done by year end. They're also rolling out an upgraded guest management system pretty quickly.
So investing in efficiency behind the scenes and maybe smoothing out the guest experience up front.
That seems to be the goal, improving back-of-house flow and making things like waitlist management better for the customer.
You mentioned beverage sales were a little soft. Are they doing anything there?
They are. They're launching new regional beverage menus for the Texas Roadhouse brand.
Regional. Interesting.
Yeah, tailoring selections to local tastes. They'll also feature mocktails and keep those $5 all-day beer and margarita deals going.
Trying to cater more specifically to different markets. Could help, maybe.
Could be. It shows they're thinking about how to optimize every part of the menu.
What about their overall franchise strategy? Are they looking to buy more or sell some off?
Their approach seems pretty consistent. They talk regularly with their remaining domestic Texas Roadhouse franchisees. If an owner wants to step back, the company is often ready to acquire the location.
So, opportunistic acquisition.
Right, but they made it clear. No plans to re-franchise, sell off company-owned stores. Any franchise expansion efforts are focused on the Jaggers brand right now.
Got it. Focus company ownership on the core brand, use franchising for Jaggers growth.
That seems to be the strategy.
It sounded like management, or at least the restaurant managers, are feeling pretty good.
Yeah, they mentioned their recent managing partner conference. The takeaway was strong passion, strong confidence from the operators on the ground. They're focused on the core food and service despite, all the economic noise out there.
That operator morale is important, definitely.
It really can be.
We know Q1 had some bumps early on, right? Weather and things.
Yeah, February was definitely impacted. Bad weather, plus maybe more flu than usual. It hit sales.
But it bounced back.
It did. Trends recovered strongly in March and continued into April and May as things normalized. It suggests the underlying demand is still there.
Good sign. And the Easter timing shift, that had an effect too?
A minor one, yeah. They estimated it was about a 50 basis point drag on comparable sales for those first 5 weeks of Q2. Just a calendar quirk, really.
Okay, let's talk beef. Always critical for them. What's the outlook?
Still looks challenging. The forecast is for continued tight supply and pretty robust demand. That points to higher prices.
Still going up.
Yeah, and they're watching herd retention closely. If ranchers start holding back more heifers to rebuild herds, that could tighten supply even more in the near term, pushing prices up further. It's a key cost line to watch.
No doubt. Rent expense also ticked up. Why was that?
Mostly driven by the acquisitions, especially buying stores in higher rent markets like California. Plus, new stores generally just come with higher rents these days.
Right. Cost of expansion, especially in certain areas.
Exactly.
And that to-go business, any more color on its profitability? Is it as good as dine-in?
They said to-go sales actually increased sequentially, which is interesting, driven by operational tweaks and just ongoing guest demand.
Okay.
Profitability-wise, they frame it this way. Assuming the dining room is full, adding the to-go order provides incremental margin dollars. On a percentage basis, it's roughly margin neutral, maybe slightly positive.
So it's definitely additive when the main dining room is already busy.
That's the idea. It's efficient volume when integrated well.
What about Bubba's 33? Any updates on how that brand is perceived?
Yeah, they did a guest study recently. It apparently reinforced Bubba's appeal as, a family-friendly sports place. Positive feedback on food quality, consistency, taste, atmosphere, all the core stuff.
Sounds like it's resonating with its target audience.
Seems to be, yeah. Bodes well for its growth potential.
And those tech upgrades, the kitchen system, the guest management, are they actually seeing benefits yet?
It's probably still early days for the full impact, especially the kitchen tech. But they said it's been well received by staff and managers. The expectation is definitely for better back-of-house efficiency.
And the desk system.
That one seems to be helping already. Better floor plan management, more accurate wait time quotes, things that directly impact the guest experience.
Okay. And one last detail, G&A expenses for the year.
Still guiding for mid-single-digit growth in G&A dollars for 2025. Pretty much in line with previous expectations.
All right, so let's try and wrap this all up. What's the big picture takeaway for investors listening to this?
I think it's resilience. The sales performance, especially bouncing back after that shaky start to the year, really shows strong brand loyalty. People like Texas Roadhouse. Operationally, they seem to be executing well.
But the margin pressure is real.
Oh, absolutely. Inflation on food, inflation on labor, those aren't going away quickly. Management seems to be taking a measured approach on pricing, trying not to alienate guests while really leaning into productivity and looking for savings elsewhere.
And the growth story continues with expansion and tech.
Right. They're clearly confident enough to keep opening stores both organically and through acquisitions. And they're putting money into technology they believe will pay off in efficiency and guest satisfaction down the road.
So strong demand, but keep a close eye on those margins and how well they manage costs.
That's the crux of it, I think.
Okay, perfect. Now let's pivot to our This Is Not Financial Advice segment. Time for some creative, maybe even slightly outrageous trade ideas based on what we just heard. What's on your mind?
All right, how about this one? The value menu Vanguard long short.
Value menu Vanguard. Okay, tell me more.
So the long side would be a basket of discount grocery store chains. Think Aldi, maybe Dollar General with their food sections, places like that.
Okay, why them?
The rationale is, if inflation keeps biting, even with casual dining showing resilience like Texas Roadhouse, some consumers might still pull back a bit. They might trade down some restaurant meals for eating at home, sourced from these budget-friendly grocers.
So betting on a bit more price sensitivity overall, driving traffic to value grocers.
Exactly. Then the short side would be Texas Roadhouse or maybe a basket of similar casual dining chains.
Shorting them, despite the strong sales.
Yeah, it's a relative play. The bet here is that the market starts to worry more about their pricing power. If they can't fully offset sustained inflation without hurting traffic, those margin pressures we talked about could really start to weigh on the stock more than the market currently expects.
Interesting. So you're playing the potential divergence. Value grocers gain from price sensitivity, while casual dining feels the margin pinch more acutely if they can't pass on costs. It's a macro consumer behavior bet linked directly to the inflation themes from the call.
Precisely. It's looking beyond just the single company's results to the broader economic forces at play and how they might create winners and losers across related sectors. It's definitely playing devil's advocate against the current strong sales narrative.
A provocative idea, playing the inflation angle from a different perspective. Okay, so wrapping up our deep dive today, Texas Roadhouse showed solid demand and skillful navigation of a tricky environment in Q1.
Yeah, key things to watch going forward will definitely be that margin performance against inflation, the success of those new stores coming online, and whether those tech investments start showing tangible benefits.
It seems their core focus on food, service, and importantly, value is still hitting the mark with consumers. Thanks for breaking down that earnings call with us.
My pleasure. Always interesting to dig into the details.